Most buyers approach the SBA the same way. They find a business they like, they look at the profit number, and they assume the business makes enough money that the bank will approve it. And on the surface, that sounds logical and completely reasonable. It even sounds smart, but here's the quiet problem that you run into if you don't know the numbers that the SBA is actually looking at. The bank is not looking at the same number you are. And by the time most buyers figure that out, they are already months into the deal and that they can't close, so they find out they can't close. My name's Trent Lee. I'm the #1 business broker in the country. I've closed over 600 transactions, and I make these videos specifically to help buyers avoid the mistakes that I see happening inside deals every single week. The thing about being this close to real deals is I see patterns. I start to see what works, what gets consistently approved, what gets denied, and what quietly fails, and what quietly falls apart after someone has already fallen in love with the business. And that's why I'm here, so you don't have to learn this the hard way. Let me give you the exact scenario I see play out more often than most people would believe. Two buyers, same business, same asking price, same SBA lender. One gets approved and the other one gets denied. And neither one of them fully understands why. In this example, the business is generating $280,000 in SDE. Solid number for a small business. It had clean books, the kind of listing that looks straightforward on paper. But buyer A needed $800,000 a year to cover his household expenses. Single, low overhead, simple situation. After setting aside his salary, there was $200,000 left to cover the debt. The annual loan payment on the deal was $130,000. He clears a 1.5 debt service coverage ratio, or DSCR. No problem. Approved, got a pre-approval letter that came through just fine. Here's buyer B that needed $175,000 a year. 5 kids, a divorce, child support obligations, a mortgage that was not moving. After the required draw, there was only $105,000 left to cover the same $130,000 payment. That comes in at under 1.0 debt service coverage ratio. That's not getting approved by anyone, no lender in the country. It's the same business, the same numbers, the same profit, but a completely different outcome. So let me slow down because this is where most buyers miss. The bank's not evaluating the business differently for each buyer. The bank was actually evaluating the buyer's financial reality against the business's ability to support itself, including pay for the family and the obligations. That's a totally different calculation than most people expect going in. Here's the framework I want you to hold on to for the rest of this video. I call it the 3 Ds: dollars, draw, and debt service. Every SBA deal lives or dies somewhere inside those 3 things. The dollars the business generate, the draw that you as a buyer need to take home to survive, and the debt service the loan requires every single year. When those 3 numbers work together, you get a green light, you'll get approval. But when they don't, it doesn't matter how good the business looks on paper, the loan doesn't work out. So here's the part that most people miss. DSCR, which stands for debt service coverage ratio, is not simply the business profit divided by the loan payments. That's how a lot of buyers think about calculating DSCR, and unfortunately, it's not accurate, nor is it complete. The actual formula is business profit minus a reasonable market rate salary for the owner that can support your family. That's relevant because not everyone needs the same market rate salary for the buyer's livable wages to be factored into. You factor that in and divide by the annual debt service. So one more time, the actual formula is the business profit minus the buyer's livable wage that you need to take out of the business divided by the annual debt service. The bank is asking a very specific question. After this buyer pays themselves enough to actually live on to support the family and to carry on the same lifestyle they have, is there enough funds left over to comfortably cover the loan? Typical SBA lenders want at least a minimum of 1.25 DSCR. That means for every dollar of debt payment, you need $1.25 of profit left over after your draw. Not $1.10, $1.25. And that cushion matters because the bank is not just approving the loan. They're betting on a human, you stepping in to run that business and keep it running well enough to make the payments for the next 10 years. But you've got to also factor in supporting your family at the same time. Here's the real world pattern I see constantly. A buyer comes to me, they have been pre-qualified with an SBA lender, which is a great start, but it's only just a start. The pre-approval letter was based on basic debt to income check on their personal finances. Nobody sat down with them and walked them through what the minimum required draw would be in the context of this specific deal, because the pre-approval letter often comes before they even have the details on whatever deal they're looking at. So they spend 2 months on a business that looks perfect by other measurements, and then the loan gets structured and the debt service coverage ratio comes back something below the 1.25 debt service coverage ratio that we need, and all of a sudden their pre-approval letter doesn't do them any good. The deal falls apart. Not because the business was bad, not because the buyer was unqualified in a broad sense, but because nobody ran the actual math against the buyer's real household obligations early enough in the process. This is where it gets personal. And I think it's worth saying plainly, your credit score is on the line. Your home equity is on the line. Your personal guarantee is on the line. Your family financial stability is on the line. This is not a spreadsheet exercise. This is a real commitment with real risk. And the single best way to protect yourself is to understand your number before you fall in love with the listing. So yes, go get pre-approved from the lender. Yes, look through businesses and look to make sure they make enough, but you have to factor in a true DSCR coverage before you spend too much time on this. So before you get too serious about a business, sit down and be honest with yourself about what you need to take home to keep your life functioning and your family supported. Not what you want, not what you hope, but what is the actual minimum monthly draw that your household requires. You need to factor in what's on your credit score because that's what a lender is going to look at. Mortgage, rent, car payments, child support if applicable, student loans, insurance, basic living expenses. Add it all up, and that's your number. And that number is the lens through which every deal you look at should be filtered. Here's the deal filter I want you to use every time you start looking at a listing. Take the SDE of the business, subtract your minimum required annual draw to support yourself, then divide what remains by the estimated annual loan payment. If the result is below 1.25, you have a problem. If it clears 1.25 with room to spare, then now you're in a territory that's worth exploring. Now it makes sense to take the next step. This does not mean buyers with higher income needs cannot buy a business. Let me be clear about that. It simply means they need to be looking at a business that generates enough cash flow to support both their lifestyle and the loan. A buyer, that same buyer before that we talked about, who needs $175,000 a year is not unqualified. They just need to buy a bigger business. Maybe a business doing $400,000 or $450,000 or greater. A business doing $280,000 in SE is probably too small for their lifestyle needs. The math works once you go upstream. The mistake is not knowing before you start. Now, for those of you who are newer to this process, the most valuable thing you can do right now is have a real conversation with an SBA lender before you make an offer on anything. Not just a general conversation or one of those generic pre-approval letters, but a real specific conversation. Walk them through your personal financial picture. Tell them what you need to take home. Ask them to give you a specific and realistic range of deal sizes that you should be targeting. That conversation will save you so much time down the road if you're looking at a business that happens to be a good business and you happen to be a good buyer, but it's just not a financial match because it doesn't generate it. It'll also keep you from making emotional decisions based on a business that you fall in love with that you can actually support your lifestyle, and you have to start to justify. Maybe I could cut down my living expenses. Maybe I can cut out some of the expenses that were used to live on a lower salary. I wouldn't recommend that. It's just not a good fit at the beginning. For those of you who have done this before, you already know the basics of DSCR. What I want you to think about is whether the deals you are analyzing are being filtered correctly from the start. Because I see this with experienced buyers underestimating how much their income requirements shift the numbers, especially if their personal situation has changed since the last acquisition. So ask yourself, do you know your number right now? Not generally, but specifically. If you can't answer that question in under 60 seconds, that is the first thing you need to solve before you start looking at any listings. So if this video gave you something to think about, there's a free school community I want to invite you to. Over 30 hours of step-by-step education on how to find, analyze, and buy small businesses. It's completely free to join. The link's in the description of the video. A lot of buyers go through it and tell me it changes how they look at deals entirely. I think it will do the same for you. Remember, dollars, draws, and debt service. All three determine whether deals get done.